Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Chatting now with Tertia Jacobs. She is Treasury Economist and fixed income specialist at Investec. Tertia, two big data points. Inflation today, MPC tomorrow. Let's start with that inflation for June. What are you expecting? We got a slightly better than expected number last time. Can we be pleasantly surprised again this morning as the data comes out?
Hello, Simon. Yes. So, well, if we look at what you're saying, a better number, it's widely anticipated that the June's inflation number will be higher, right? Mm-hmm. So May's number was 4.5. Currently, we're looking at about 4.7%. I think what's going to be quite important in this number is the core CPI inflation, because it's now like 3 months into the war. Mm-hmm. Yes, we had some petrol price cuts, but we're going to see if there's any, pass through from the higher fuel price into core goods.
And that is my sense, the real concern. We get the fuel price that is going to be dependent on oil and exchange rate, and not a lot we can do it. But it is that pass through, that second round effect that perhaps is the big concern that we need to keep an eye for.
Yes, I agree with you.
In terms of MPC tomorrow, they're obviously going to get this data. They meet today, they meet tomorrow. The announcement will be 3 o'clock with the governor and his team. What's your expectation there? Or is it really a lot riding on what the number is we see later this morning?
So that's a very important question, because we have seen in the past, for example, where the inflation rate is sometimes published the day before the MPC meeting. And then it comes out a little bit better, but the MPC still goes ahead and hike, right? Mm-hmm. I think the thing is they decision is not shaped on the most latest data. Yeah. They have their forecast with their assumptions, and that is what influences the decision. So, for example, the May's inflation rate that came out lower, while that is also important, it lowers the trajectory of inflation going forward. So I think that will help to lower the near-term inflation forecast of the Reserve Bank. Yes, what we can add perhaps is that, when you compare the landscape that's driving inflation, from as early as last week, it has definitely changed again. So what we will also be wondering is, to what extent the Reserve Bank has already been more cautious going into this meeting, because, our view was that the Reserve Bank could hold because the level of real interest rates are relatively high, right? We're not starting from a low point. We expect them to lower the near-term inflation forecast. The fiscal position looks very good, so that must count for something. Yes, inflation expectations ticked up, but 2-year inflation expectations are below 4%. So how will the Reserve Bank weigh these things? So it's certainly going to be a very interesting meeting tomorrow.
They voted 4-2 last time in favour of the increase, 2 voting in favour of no change. So we're kind of close. We just need a small tweak there to get it to the no change. Are they looking at? We've been hearing lots of talk around drought effects potentially coming later in the year. Is that something which they would have on their radar as a concern down the line, potentially impacting into food, or is that simply too unknown and too far into the future?
I think the way the Reserve Bank looks at it, it is too soon, but it's certainly on the radar. So it will feature on the balance of risk assessment. So that will feed into future rates decisions. And I think our expectation is, that's going to have a bigger impact on food price inflation in the middle of next year. So we don't expect it as soon as this year.
Gotcha. Because, of course, there's that lag effect in terms of food planting until it finally gets to our table. A quick last question. I mean, the irony is that a 4.5 or even a 4.7 inflation print just a year ago would have been bang smack in the middle of our target range of 3 to 6%. Have we shot ourselves in the foot by changing the target to 3% with 1% either way? And to be clear, I was in favor of it. I thought it was a good idea, but we're now kind of paying the price for that.
We get those questions quite often. I think when you look back, how the stars have aligned to get inflation to 3%, it was actually, all the drivers that are now pushing inflation higher that were quite low. It was a low oil price. It was a very robust rand, although we can add that's also a constructive factor that the rand is relatively low. FX volatility is quite low. So all of those dynamics have changed now. So I think it's a very difficult question. It is what it is. We're not going to go back to 4.5%. But the question is, how will the Reserve Bank then play it? And I think this is where we're looking at an environment where interest rates can perhaps stay higher for longer. And very importantly is then how anchored is inflation expectations. So that basically means, that the MPC will continue to sound very hawkish. They will try and influence expectations, so that in a way it could become more self-fulfilling. The problem is that sometimes, inflation expectations are shaped by where the current inflation rate is.
Got you. And it is. We keep coming back to now chat with guests. Inflation expectations is the big one. We'll leave that there. Appreciate the early morning time. Tertia Jacobs, she is Treasury Economist and fixed income specialist, Investec. And our poll today on LinkedIn is, what do you think MPC is going to do tomorrow? Have your vote. Have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management.